Hi, good afternoon, and welcome to Navigating the Mosaic of Trusts, Taxes, and Portfolio Construction. I'm your host, Geoff Zimmerman, and with me today is our guest, Carla Bryant from Mowat, Mackie and Anderson. Hi, Carla. Welcome.
Hi, Geoff. How are you?
Doing great. How are you?
Good.
Before we get started, I wanted to cover a few housekeeping items. The first one is we have everybody on mute. And the second is, if you have a question, then go ahead and type it into your console, and our assistant here will read the question and give us the questions as they come in. Don't be shy. Also, we are recording this today, so for those of you who want to go back and review the presentation, we'll have it posted to our website, www.mosaicfp.com, coming up in the next several weeks. So with that, shall we get started?
Let's get started.
Awesome. Okay. So, we're going to cover a few topics today. The first will be the tax components of the Affordable Care Act. The second, we'll go through some definitions and some key numbers for planning for 2015. We'll talk a little bit about asset location and portfolio design as it relates to trust and taxes. We'll be talking about asset types and their tax characteristics. And finally, we'll go through a few examples. Carla, why don't you kick us off a little bit and talk a little bit about the Affordable Care Act and the taxes?
The Affordable Care Act was enacted in 2010. It was effective last year in 2013. And we're going to talk about some definitions as we go before we actually get into how it affects taxes. First of all, the FICA rate remained at 6.2% for the Social Security section, and it remained at 1.45% for Medicare. However, there are now additional Medicare payroll taxes on wage earners and for the self-employed, and that is 0.9% on income above certain thresholds. And there's also an additional Medicare contribution tax of 3.8% on net investment income, again, above certain thresholds.
Excellent. So as we get into this, we should probably talk about a few definitions. We'll be using some jargon, and we want to make sure that we're all on the same page here. So first, when we talk about wages, we're talking here about earnings from paid employment. Second, when we refer to adjusted gross income, this is your gross income from all sources minus specific reductions, above the bar reductions.
Exactly.
The third is similar. It's called modified adjusted gross income, and this is your adjusted gross income plus income from sources that are usually excluded from adjusted gross income. And examples of this would be, for example, tax-exempt interest from municipal bonds or the normally excluded portion of Social Security benefits.
Which is 85%, or which would be 15% for most of our clients.
Right. Right. Taxable income, by contrast, is adjusted gross income minus allowances for personal exemptions and your itemized deductions. Taxable income as it applies to trusts is a little bit different, and so we refer to IRS Form 1041. Taxable income for trusts includes income from all sources, minus allowable fees, like trustee fees, expenses, allowable deductions, and income distribution deductions. And this is going to play an important role in our conversation today. Realized capital gains. So this would be income realized on the sale of a capital asset to the extent that sale price exceeds purchase price. And there are lower rates that apply on sales of assets that are held longer than a year.
That's correct. We'll call that long-term capital gains. I think that's a good start on the definitions. If I would say to our audience, if there's something that you don't understand, please send in a question and we will try and work on a definition for your question of the term that you don't understand. We're going to continue now with definitions of net investment income. Net investment income is a term that we use in the Affordable Care Act, and it equals investment income less allocable expenses. And that includes, but is not limited to, things like interest, dividends, capital gains, rental income, royalty income, non-qualified annuities, and other types of income that might come. And it also includes the gains from the sale of partnerships, S-corps, etc. And some real estate, not excluding your personal residence. But the second home, however, is included in there if you have that, because it's not your primary residence. Generally, and I use words generally, it does not include wages, unemployment compensation, Social Security benefits, alimonies, IRA distributions, 401k plan distributions, IRA to Roth conversions, and gains that are excluded from gross income on the sale of your principal residence, which I mentioned earlier.
Right. And the importance of this when we're talking about net investment income is that's going to apply when we talk about the 3.8% additional Medicare tax, correct?
That is absolutely correct. Now, we've just talked about the income. There are some deductions that apply to that, too. And those would be things like investment fees, state taxes that apply to that income, etc.
Good.
Okay.
That's good to know.
Okay.
Right.
Okay, Medicare taxes in more detail. It's Medicare tax for high earners is 0.9% on earned income over $200,000 for singles and $250,000 for people that are filing married, filing joint. It includes exercises of non-qualified stock options, SARs, and vesting of restricted stock. Employers begin collecting on your workers' income when it's over $200,000. But this can cause a problem because, and I'm just going to interrupt with an example here. Say that you have $200,000 of income from one employer and maybe $90,000 from the other employer. So that would give you $290,000 of taxable income, but you would only have you may or may not have enough withholding on that income, therefore.
So if I'm working and earning and haven't hit the $200,000 threshold and my wife is doing the same thing, that it's possible we might not have any Medicare taxes, payroll taxes withheld over and above the normal, but we might get an unexpected tax bill at the end of the year. Is that what you're saying?
Yes, exactly. And that happens quite frequently. So that's where we're looking at. And it also applies to self-employment income, and a lot of people don't realize that. So our high earners that have self-employment income, it applies to you too. It is not applicable to trusts, but trusts ordinarily don't have wage income or earned income in them anyway. But we talked about the trusts having beneficiary distributions, and we need to take that into account with the beneficiaries because maybe that trust distribution will put them over these limits.
Ooh. That would be unexpected and
yes,
not a good
it is,
surprise.
and it's not a good surprise.
Wow.
Okay.
Well, so far we were talking about Medicare taxes on payroll and earnings. Let's talk a little bit about Medicare taxes on unearned income. And so for individuals and couples, we're talking about net investment income here. And Carla, as you mentioned earlier, this is income from capital gains, interest, dividends, and so on and so forth. And we're adding back in municipal bond interest there, correct?
That's correct, and that 15% of Social Security.
So that tax-free muni isn't quite so tax-free as we thought it might be. This is going to be 3.8% on the lesser of unearned income, net investment income, or, and here's that technical term, modified adjusted gross income in excess of, and here's a couple of three different numbers, in excess of $200,000 for people filing single or head of household, or modified adjusted gross income over $250,000 for couples married filing jointly, or if you're married but filing separately, the threshold is lower at $125,000. So that's for individuals like you and me.
That's right, but the real kicker comes next. It's that modified adjusted gross income for trusts, which is $12,300.
So if I have an irrevocable trust, it's generating income, and it's got more than $12,300 that it's retaining in, say, capital gains. Do you mean I'm paying an extra 3.8% on those?
That's exactly what I'm saying. And that's one of the reasons that we're having this discussion today. Good
discussion to have.
Yes, it is. Let's talk a little bit about capital gains tax rates. Capital gains tax rates are divided into two main pieces. The assets that are held longer than 1 year, which is long-term capital gain rates, and those are 15% if income is below thresholds. It can also be 0 if it's really below a certain low threshold, or 20% when income exceeds other thresholds. And we also have assets that are held less than 1 year. Those are called short-term assets, and they're taxed at ordinary income tax rates.
So I want to be holding assets longer than a year, and you're going to tell me how to get to that 0% capital gains rate, aren't you?
I'd love to do that. But, we're talking primarily about high income earners here, and most of them aren't going to see that. But we'll get into that a little bit later when we talk about the tax brackets.
Cool. Let's talk a little bit about the thresholds for long-term capital gains. And Carla, can you help me understand a little bit about how that works?
You mean the 1-year holding period?
The 1-year holding period,
Yeah, absolutely.
And how the Medicare tax impacts that.
The Medicare tax is on, especially, it's going to be on 3.8% of net investment income. So you're going to pay that really, quite frankly, on whether it's long-term or short-term.
Okay.
So that's not the issue. The issue is that you want it to be long-term capital gain because the ordinary tax rates are much lower on long-term capital gains than they are on short-term capital gains.
Okay. Are there any income thresholds where I might move from that 15% to a higher long-term capital gains
Yes,
bracket?
there are, and that's what we're going to talk about next. Assets that are held longer than 1 year for sale for individuals is 15% if the taxable income is below $413,200 for single filers and $464,850 for married filers. So it's a high threshold there.
So if I'm an individual, if my wife and I are making a pretty good income and we're above these thresholds, then our capital gains is at 20%.
That's correct.
Is that the same for that irrevocable trust I mentioned earlier?
No, we're back with the trust. The trust is at 15% when income is below $12,300, but anything above $12,300 is at 20%.
Wow.
So you're not. It's really, we would say, a double whammy for the trust. They get the 20% tax rate and they get the 3.8% tax on top of that.
I suddenly feel like I'm possibly going to get hit pretty hard with taxes.
You are, and that's one reason that you need to look at your trust funding especially for a bypass trust if you have that trust, where all the capital gains are going to be held at the trust level.
Ooh, that sounds painful.
It is painful, very painful. That's why we have you today to tell us how to reallocate those portfolios.
Well, we'll be talking a little bit about asset placement strategies and how we might use different characteristics to help alleviate the taxes. I think the only way we get away from it really is to not make any money.
And that's really not the end-all solution.
Yeah, that would not be a recommendation.
No, it certainly would not be.
I'm going to talk a little bit, and in the handouts, we have a high-level view of how these taxes stack up. And just very briefly, for individuals who are married and filing jointly, at levels below $200,000 in taxable income, we're at a 28% federal tax bracket. As our taxable income ramps up from $200,000 on up to $464,000, we very quickly escalate from a 28% federal tax bracket to 39.6% on income. And at the same time, our capital gains rate escalates from 15% on up to 20%, plus the 3.8% Medicare taxes. So over a fairly short period of time, the tax burden ramps up very quickly. If you're single, the numbers are a little bit different, but the impact is the same. So at taxable income below about $190,000, we're in the 28% tax bracket. Once we go above $413,000 and change, we're up to 39.6, federal tax bracket, 0.9% Medicare tax, and 20% capital gains with an additional 3.8% on top of that. And so very quickly, capital gains and ordinary taxes go from moderate to fairly high.
And remember, we're not even talking here about if it's earned income, we have another 0.9% tax on that.
That's right. Last but not least, as Carla, you pointed out, for trusts, it's a very compressed tax schedule. And so I'll go through these numbers in a little bit more detail. And for the folks who are managing irrevocable trusts, this would be a bypass trust, a marital trust, for example, or other forms of irrevocable trusts, at taxable income below $2,500, which is not a lot. The federal tax bracket there is 15%, as is capital gains. As taxable income for the trust goes above $12,300, your federal tax bracket has jumped to 39.6%. You've got a 20% capital gains rate and an additional 3.8% on net investment income that's retained by the trust. So very quickly there, from $2,500 to $12,300 in taxable income, the tax brackets have increased dramatically.
That's correct. And I think you need to, because of the situation that we have now with the income taxes for the trust, you need to talk to two people. Number one, you need to talk to your financial advisor about how maybe to restructure the assets that are in the trust, and the other person you need to talk to is probably your attorney to see if there's any way to modify the trust in any way, shape, or form so that you don't have this situation. Or if you are still doing your estate planning, it's really important that you look at how to maybe bypass some of these issues. That's bypass the bypass, I guess we would say.
I like that.
do it that way. But you need to look at both estate planning and asset allocation for your assets that are in the trust.
And you didn't say this, but I think it's implied, and I'll say it explicitly. It's important to have your tax person, your CPA, as part of the team. And ultimately, having all the members of the team talking about this.
I think it really is. At our firm, we have a saying that tax should not be the tail that wags the dog, and I think that's really important. We are a team approach here, and we need it, especially with the new income tax levels.
Decisions made in silos are often good decisions in that silo, but bad holistically. And
that's correct.
If we're working as a team, I think we can all serve our clients well.
That's right. I'm going to talk for a few minutes about some additional considerations that you might want to take a look at too that have come up. And these are not the result of the Affordable Care Act, but they're a result of some new tax laws that went in 2013. First of all, there's a 3% reduction in itemized deductions for each dollar of AGI in excess of thresholds. And that's come back into play. Also, for a lot of our clients, in fact, in our case, almost most of my clients are in alternative minimum tax. And alternative minimum tax is a parallel system of taxation that we have in the United States that was originally set up to catch people that were in higher income tax brackets or were using tax shelters. And because of our usual stopgap measurements in the Congress, it hasn't been reformed as it should have been, so it hits a lot of people, especially people in California, or people that use state income taxes as a deduction. Because one of the things that alternative minimum tax does is it doesn't allow you to use some of the deductions that you normally would use. And a big one is income taxes. Another one might be that second mortgage that you took out for the trip to the Caribbean. That's not really deductible for alternative minimum tax, the interest on it anyway.
So that trip cost me more than I expected.
Exactly. However, if you use that money to put a new kitchen in the house, you're fine. But the trip, you're out of luck.
My wife Lynn will be happy to hear that.
She wants a new kitchen, I understand. And it also includes, I'm sorry about this, Geoff, but it also includes investment advisory fees.
Oh boy.
So those are some of the things that come back into play with alternative minimum tax. And it applies to individuals, couples, and trusts. And there are there's 4 tax brackets, but we're not going to get into exactly how that works. But there's a 0 tax, a 26, a 35, and a 28. And what we do in our firm is we do a lot of year-end tax planning, trying to help our clients avoid alternative minimum tax. Or if they can't avoid it, we try and schedule their tax payments, for instance, for California tax, in such a way that we can maximize the use of that deduction.
Sort of, if you're going to be in AMT, then how do you make lemonade out of lemons?
That's exactly what we're talking about. I mean, maybe some years you won't be in it, some years you will be in it, so how do we work with that? And unfortunately, some of our clients are in it year after year, and there's not a lot we can do there. But we always look for, as we would say, the sweet spot there. How can we help our clients with AMT?
I've heard a little bit about this sweet spot. And Carla, your opinion on this. I've heard people say that if you're in AMT and you've already phased out of the 35% phantom bracket, that it might be better to accelerate some income and pay tax at 28 cents on the dollar rather than 39.6.
That's correct. I actually worked with a client this year, and that's exactly what we did. We figured out how much more income, and I believe it was like he needed $30,000 or $40,000 more to hit that sweet spot. So that's what we did.
Sounds like an example of
Exactly.
making lemonade out of lemons.
It does, as best we can. But that's why you need a good tax advisor.
A quick question, because I get asked this periodically, and I don't think there's a good answer for this, but I'll ask you anyway. Is there a way to tell, or are there certain thresholds that if I say I'm going to make this amount of money, am I going to be an AMT or am I not? And I don't think there's a correlation there, but what's your take?
It's very difficult to say that because a lot of it depends on the type of income you have, and a lot of it depends on the type of deduction you have. So it's really an individualized, for most people, calculation. And we have that question a lot too. Oh, how can I get out of this or into this or whatever we need to do to make the tax rate lower? And it's really a case-by-case situation. That's one reason we do so much year-end tax planning for our clients.
Well, sounds like that's something that people aren't doing that they really ought to consider doing is the year-end tax planning. Cool. You mentioned earlier a little bit about tax characteristics of investments, and as you know, we have a asset location hierarchy when we manage money for client portfolios. And as it pertains to the trust, well, first, at a high level, we have a philosophy around trying to place tax inefficient investments, and these would be things that spin off ordinary income, in tax deferred vehicles.
Exactly.
And trying to place tax efficient investments in accounts where we can take advantage of things like long-term capital gains rates, or in the case of trusts, move them out of a trust with a compressed tax structure into a trust where there might be a little bit more room to absorb income without getting into the top tax rates.
Exactly, and that's what we need. That's where we need your expertise to come into play. And it's become even more important with the new tax laws that we have. So, exactly, and let's kind of, I'm going to talk a little bit about it when you can join in, or we'll do this together here. The asset location considerations are, part of it has what's a trust for? And trust, can have a number of purposes. They could be a bypass trust to avoid estate tax. They can be a special needs trust to provide income for that special needs individual. They can be a trust where we want to put the money in trust just so someone can't spend it all as soon as they get it. That child that's 21, we don't want him to have all of the money right away. We really prefer that he's 30 or 35. Trust can have different purposes, and those purposes for the trust also drive how we allocate the assets and the tax situation for the trust. And part of that is, who are the trust beneficiaries? Who's going to get the money, and what is their tax situation?
And if my two trusts, if my survivor trust and bypass trust has different beneficiaries, then that affects how we might invest assets in each of the trusts, right?
Exactly. And that becomes even more complex because as a fiduciary or a trustee of the trust, you have the responsibility for balancing the needs of the income beneficiary and the needs of the residual beneficiary. The income beneficiary is the person who's going to get the current income out of the trust. The residual beneficiary is the person who's going to get the residue of the trust after someone passes on or at the end of the trust term.
So now we're navigating a bunch of different pieces here.
Oh, yes. That's why we have trust litigators.
What about limitations written into the trusts? Do you find that there's often any operational limitations as to what the trust can do or invest in, or?
Yes, there are. And frequently, I don't find it so much as to what the trust can invest in, but there are operational limitations on that. Maybe they can only have so much income. They can only have maybe they can have the income from the trust. They can only go into the principal of the trust for health, maintenance, welfare, etc. And then we have all of those issues that, what is health? What is welfare? What is education? And how do we invest for income versus, because income goes out, capital gains stay in the trust. What kind of investments will generate that type of income? We also need to look at the tax situations for both the income beneficiaries and the residuary beneficiaries. as well as a trust. So now we're balancing three balls in the air: the trust income, the residuary beneficiaries' income, and the income beneficiaries' income. With all the tax laws. So let's just make it even more fun.
So if we're distributing income out of an irrevocable trust to a beneficiary, we want to be looking at their tax bracket as well and determining how that affects the investment selection?
That's correct. Or even the residuary beneficiary, they're going to want to make sure that they've had some growth in that trust over the years too, and that the income beneficiary hasn't gotten all the benefit of the trust. So as a financial advisor, you have that wonderful situation where you need to make sure that the assets in the trust grow and that the income beneficiary has sufficient income coming out of the trust. Good luck.
Good luck. I think you're part of the team too.
I just have to figure out the tax situation, which is equally complex.
All right, so it sounds like this is going to affect the structure of the investment portfolio, the allocation of the investments between different asset classes. We want the desired risk and return characteristics to drive the goals of both the current income beneficiary as well as the goals and objectives of the residuary beneficiary. And this is going to affect what we include in terms of specific investments and their tax characteristics.
And we don't want to drop one of those balls.
That's a lot of stuff.
It certainly is. And I'm going to turn it over to you right now to say how we should construct that portfolio then.
Well, to be clear, this is not a one-size-fits-all, and we need to take all of these different moving parts into consideration. At a very high level, when we construct portfolios, we're looking at using either stocks or stock mutual funds or exchange-traded funds, and these drive the growth of the overall portfolio over the long term. We're also using bonds or bond funds, and this can produce current income. This can also mitigate or help reduce the overall risk of the portfolio by balancing against the equity risk. We also use a category that is used widely in the industry called alternative investments, but everyone has their own definition of what's considered to be an alternative investment. And so for us, we're including here real estate, which can either be individual real estate investment trusts or funds that invest in real estate, commodities through funds or exchange-traded notes, master limited partnerships, merger arbitrage strategies, and managed futures. And I can talk a little bit about the characteristics of each.
Please do, because I'm sure by now, at least I'm going, what was that last one?
Well, at a very high level, stocks and stock funds tend to generate more long-term capital gains. And Carla, as you pointed out earlier, capital gains, even at the 20% level, tend to be below ordinary income rates.
Absolutely.
Stock funds, if they're invested in dividend-paying stocks, also tend to generate more qualified dividends. And talk a little bit about qualified dividends.
And qualified dividends essentially are taxed at the same rates as long-term capital gain rates.
So those would be desirable.
They're absolutely desirable. One of the things I will tell you, though, that we have to watch as we're doing year-end tax planning, we will say to an advisor, what is the gain this year for stocks sales? And they will give us a gain, but they don't give us the capital long-term capital gain distributions. And so we do our planning on that basis, and then, oh, whoops, we have another $20,000 of long-term capital gain distributions. That's really important. But that's a good thing to have because it does get taxed at lower rates.
Those usually occur toward the end of the year, so
That's
that means
correct.
Year-end tax planning, there needs to be good communication between the advisor and the advisory
Right.
team.
And it's a very tight timeline in there because you don't know what's going to happen sometimes until, so we're trying to figure out if we need to have a client, for instance, make tax payments to California before December 31st to be included in the deduction for that year, or do we need to have them wait? So we try to get the best number that we possibly can to judge that tax on, but in some cases, if we have significant capital gain distributions, we may have them make another payment before January to cover that.
So it's good to know then.
Yes, exactly, and we need to know that as soon as possible.
Talking for a moment about bonds and bond funds. Bonds and bond funds generally tend to produce more ordinary income. And I think we said earlier that can be taxed at a very high rate, up to 39.6% at the federal level, plus state income taxes, and if the overall taxable income is high enough, then we're getting into the 3.8% Medicare tax
correct.
as well.
And that, remember, that 3.8 is not only on regular bond funds, but it's also on muni bond funds.
So my tax-free munis, as I said earlier, may not be as tax-free as we thought.
That's right, and that's one of the considerations that you need to take into account when you're funding these trusts and other asset allocations, because you're looking at the spread between the taxable interest and the non-taxable interest, and now you have a new component in there.
That's right, the tax equivalent yield, which
That's right.
suddenly there's a new element in that calculation. Real estate. Real estate can be a little bit different, and it's my understanding, and Carla weigh in, that income can be sometimes a combination of ordinary income, return of capital, and capital gains.
That's correct, and they have different tax rates for those components. So when you're using REITs or real estate, you have to kind of know what's going on in that situation. The same thing with, let's say you're using an oil and gas partnership. Those come in at different rates too and have different aspects. The other thing I would say, and I happen to know that you don't use a lot of these, but if you have partnerships that have a lot of foreign income, that can add a great deal of complexity to the tax returns.
You're right, we don't use a great deal of those, but good to know.
But I have clients who don't realize that. And so we get the tax returns, or the K-1s in, and all of a sudden I have a lot of foreign tax components on there. Or a lot of states, a lot of multiple states, and that's going to increase their costs for doing the tax returns, because we have to take all that into consideration.
It takes a lot more of your time to do those.
Exactly.
Whew. The return had better be worth it.
That's right. That's what I'm telling you. It's better be worth it. Otherwise, I'm going to say to them, this is your bill and this is how much it is, and please go talk to your financial advisor about why it's this much this year.
Last but not least, I mentioned this category called alternative investments. And generally, for our purposes and the ones we use, they're generally considered to be tax inefficient. The tax efficiency does depend on the type of investment vehicle, and we can use sometimes exchange-traded notes, which in some cases can help defer any gains until the note is actually sold. Other times they'll produce income. We have exchange-traded funds, which tend to be very tax efficient and don't tend to have a lot of those year-end distributions that you mentioned. And then there's mutual funds, which can have more of the pass-through distributions and make that year-end tax planning a little bit more complex.
And it makes it more complex. And I think, again, that you've mentioned one thing earlier that I think we need to remember on your end is, if you're going to have, you're going to try and put those investments that generate a lot of income into like retirement plans and that type of thing. We used to try and put some of it into various trusts, but we don't have that option anymore. It makes trust planning a lot more difficult from the financial asset calculations for taxes.
A lot of moving parts.
It is.
Great. Carla, as you mentioned earlier, some of the things that we need to consider in all of this. If we're dealing with multiple trusts, we need to be looking at the financial situation for the current income beneficiary. And that involves their needs, their goals, how much capital do they need to live out their lifetimes and do the things they want to do. We need to look at their current tax bracket, but we also need to try and peek into the future at their current tax bracket. Are they subject to alternative minimum tax? Because that affects some of the decisions in the tax rates. Age and longevity, and the investment risk profile.
And I think, looking at this, I think the age issue and longevity issue is becoming more and more of an issue for a lot of our clients. They're going to be living a lot longer than what we had anticipated. And that's going to change the structure of the trust and their income needs.
So that means the current beneficiary might not just need income, they might need a little bit of growth to last their lifetime as well.
That's right, and that's something that that's been a big change in the last few years, is as people do age and live longer and longer, that we need more growth in those portfolios than we might have needed at an earlier stage.
It makes sense. Portfolio management for tax efficiency. So weigh in some of the things that we can do to help mitigate taxes. You know.
And the first two items on this list or this slide really are the things that we look for every year. The carry forward losses from prior years. I don't know how many times I have seen financial managers continue to have losses in the portfolio for tax purposes, and we really don't need them because we have a lot of losses from prior years. However, having said that, we had a lot of people in the last few years that have had a very unpleasant surprise because all of those losses that were generated back in 2008, 2009 are now gone. And oh my goodness, we have nothing to shelter them with anymore. So I think that's one of the places where we as tax advisors and you as financial advisors really need to make sure that we're in agreement and in communication. We would expect you to harvest losses at the end of the year. I mean, that's something we look for. Let me talk a little bit. Placement of tax efficient assets we've discussed. Let me talk a little bit about the frequency of trading. This is, shall I say, a sore point with me. I understand that sometimes that's necessary. But on the other hand, again, this is something that when I'm trying to prepare your tax return, and I have an account that has 60 pages of stock trades, and you have generated $200 worth of capital gains, you've actually really done your client a disservice because I have to record all of those transactions for the IRS.
That sounds like it takes a lot of your time, so that $200 in capital gains
exactly.
doesn't begin to cover
Even if we can do them now electronically, you understand, it takes a lot of time.
I would also think, Carla, that frequent trading leads to more realized short-term gains,
Absolutely.
which are taxed at a higher rate.
That's correct.
So we really want to be looking at the portfolio frequently, making sure the allocation's in balance, but trading infrequently, and when we do trade, being careful to try and hold assets longer than 1 year in the taxable accounts.
That's right. And the other thing that we don't like to see a lot of is wash sales.
Oh.
I notice. Yes, we feel the same way.
Oh.
And I think we've talked a little bit about the ability to shelter those assets in things like IRAs and that type of thing. The other issue that we're running into now is the terms of the trust, particularly the trusts that were done earlier, and with regards to distributions. Most of those trusts tell us that we can only distribute out income, which leaves all of the capital gain income, as we've talked about, in the trust to be taxed at 23.8% for the federal plus California, and California makes no distinction between capital gains and ordinary income. So if we look at 23.8 for the federal rates, and we add, let's say, another 9.3% for California, or
Ouch.
maybe more, exactly, there went 1/3 of our income.
Carla, for the non-attorneys who are watching, who aren't familiar, isn't income, or is there a difference for trust purposes in income and what's distributable and what's not?
There is, and trusts have their own definitions of income. For instance, one of them that that most people aren't aware of is making the trust the beneficiary of an IRA. Let's say, if that income at the trust level, then the income isn't considered as income. It's considered 90% principal and 10% income. So then I have 90% of that distribution that can be caught at the trust level and taxed at the higher rates.
So if I'm hearing you correctly, the IRA with the trust as beneficiary that's distributing income, it's distributing income to the trust, but it goes into the trust, and it's not all considered income that can be distributed out to the income beneficiary and taxed at their rate. It's being stuck in the trust. And didn't we say earlier that the trust hits top tax bracket at $12,300?
Yes.
And that sounds like a really bad outcome.
And an issue sometimes with our annuities too. Now, that's not always the case. You may have a case, let's say, where someone has passed away, and so we can do a look through because the trust is going to get the IRA income, and that's going to pass it out directly to the beneficiaries. That's kind of another scenario. But the scenario where it gets trapped at the trust level can be really devastating for taxes.
Sounds like one needs to tread carefully and plan appropriately to try and avoid that type of situation.
Exactly.
Also, you used a term, and I think I used it earlier, and it occurs to me that it might be a bit of jargon. Harvesting of losses. Do you want to talk about that, or shall I?
Go ahead and talk about it.
Okay. Harvesting of losses is an investment management technique, and it's particularly useful where the investment manager uses similar but not identical investment vehicles, and thus can avoid the wash sale issue that you raised earlier. Harvesting of loss would be taking a security. An example might be an S&P 500 index fund that was held in 2009. It dropped in value. You wanted to take advantage of that, but you wanted to also remain invested. So you could sell that fund and buy a similar fund, like a Russell 1000 index fund, which would be similar in investment characteristics, but not identical. So you can remain invested and then capture that realized loss to use in future years when I realize gains.
That's correct.
Does that work for irrevocable trust too?
Yes.
Cool. So that might be a way of if we have realized any gains in the trust and we have securities that we're holding at a loss, a way to try and neutralize those gains and stay out of that top 20% plus 3.8 tax rate.
That's correct. The one time this doesn't work well for us is if we have someone that passes away on their individual tax return and we have a lot of losses, we lose them.
Gone.
They're gone, along with their NOLs. So if you have an individual in that case, you might want to watch how much loss you have in there.
What about...
But on the trust level, they flow out to the beneficiaries in the final year of the trust.
So that sounds like a good thing.
That's right. Providing the beneficiaries have capital gains to use against them.
Or in future years.
In future years, that's correct.
Well, we certainly hope so. All right, so let's talk a little bit about some practical examples here. The first one is around Medicare tax on non-interest income. And this is in your handouts as well. The assumptions here are a couple married filing jointly. They've got household wages of $230,000 and investment income of $40,000. So the term we used earlier, MAGI, or modified adjusted gross income, here is $270,000. We said for a married couple filing jointly that the threshold was $250,000, and so our excess of investment income over $250,000 is $270,000 minus $250,000 is $20,000, which is the excess. $20,000 is less than the $40,000 of investment income, and we said we're going to pay surtax on the lesser of the two. And so our surtax here, our Medicare tax, is 3.8% times $20,000, or about $760 in tax.
That's correct. And let's remember that it may not even be that high because we may have some deductions that we can take against that $20,000.
That is true. That is true. So Carla, talk a little bit about a more complex example, if you would.
Okay. And our example here is, and we're going to deal with trust funding now because the trust funding, because of the new income tax laws, becomes a different animal than it used to be, for lack of a better term. We used to be more concerned about the estate tax, we were about the income tax, and now that's not quite the situation. We have $10.86 million that's not subject to estate tax, but we have much higher capital gain rates, tax rates. So we're going to look at this in a little bit different way than what we might have done at one time. And let's just assume in this example that we have the usual AB trust, the survivor trust, the bypass trust. And essentially what we're going to say is that they have, it's a 50-50 split. Okay, so
Carla, very quickly, we've assumed a couple and one of the spouses has died, and now their trust is requiring them to fund both trusts, correct?
That's correct. Okay. And in this particular case, they have a $2 million house and a $6 million portfolio assets. And the survivor has income of $100,000, and that $100,000 is from pensions, Social Security, etc. And the trust has a formula that requires the funding of the bypass trust. And most trusts that are out there still have that requirement. That's one of the things you may want to bring an attorney in if both spouses are still living, to look to see if you actually want to do that. Is there any reason for doing that? if the beneficiaries of both the bypass and the survivor's trust are going to be the same, maybe you don't even need the bypass trust anymore.
Why would a trust have a mandatory funding requirement? How did that come about?
It came about when we had the lower exclusions. I mean, I was working with one the other day where we had a $625,000 exclusion.
Wow, doesn't that go back to 1997, 1998?
Yes, exactly.
Or so?
You've got it. It was a 1998 trust. Good job, Geoff. But anyway, we did the bypass trust and made it mandatory so that we took out that much money on the first death. And so that's the way it was funded. And now with these high thresholds plus portability, which we'll talk a little bit about in a minute, the bypass trust may or may not be necessary. The other thing that happened with bypass trusts is, let's say we had a second marriage, which is over 50% of all marriages now. And I'll say dad, sorry, you men die first, usually.
It's sad, but we do.
So dad dies first, and dad had children, and he wants to leave his assets to his children. And so the bypass trust might have had beneficiaries that were his children. Now his spouse could continue to get the income from that for her life, but when she passed, his children would get the assets. And that's still a reason for having a bypass trust if that's the situation.
Good. So it's not automatic that things should be changed. It goes back to the goals, the circumstances, protections.
Exactly.
Let's carry on for a second. So let's suppose for a second that there is a bypass trust. It is mandated. And now you've got what did we say, an $8 million estate with $4 million being forced into the bypass trust and $4 million going to the survivor. Talk a little bit about, so what happens? So what do you fund and what do you do there?
So right now our exemption for the couple is $10,800,000.
So at $8 million, no estate tax, regardless. Is that correct?
No, we have no estate tax.
Okay.
And 50% of it, because we have $8 million worth of assets, 50% of it's going to go into the bypass trust, or $4 million. And I'm going to put a little caveat in here. The bypass trust cannot be funded with IRAs if there's a beneficiary, or items that have beneficiary designations, maybe life insurance as another example, or IRAs. So those can't be used to fund the bypass trust. Okay?
So if a client has a lot of money in retirement plan assets, then that can create problems.
Exactly.
There.
That's another issue which isn't addressed in this particular example, but I wanted to mention that while we were talking about it. So anyway.
What about the house? I've seen house-heavy people. Do you have any thoughts or feelings on putting a house in a bypass trust or a survivor's trust?
We have a $250,000 exclusion on that house.
That's the capital gain on sale, isn't it?
Right.
Okay.
So, we probably in a lot of cases, and the bypass trust, once it has a step up in basis, it's not going to go any further. But the survivor is going to get a step up in basis when they pass. So we probably will usually put the house now into the survivor's trust, or we'll use another technique that we might talk about later called doing a note against the house. In this case, we're going to fund with the house in the survivor's trust, and then if you look on down, there's various tax brackets that she'll be in, and so
because she has $100,000 worth of income.
That's right.
So she's got a ways to go before she hits 39.6.
Exactly. So if she's in the 28% tax bracket, she could have income up to another $189,300, and she could have taxable income of $413,200 before she gets into the federal 15% tax bracket. So you're going to fund the survivor's trust, which you're going to have to fund part of that with the securities in a different way than you're going to fund the bypass.
It almost sounds like because of the compressed tax brackets that all else being equal and not accounting for possible differences in beneficiaries, that we would want less capital gain retained in the bypass trust.
Absolutely, because we don't want to pay tax on it.
That's right. And we want more of that income coming through to the survivor, where we can take on that income without hitting 39.6.
And the other thing that happens is we want the growth to happen in the survivor's trust, because under the new estate tax laws, she has $1.4 million exclusion from his death that she can use on her death. So at her death, then she's going to have half of the 5.4 plus the 1.4 from him. So she's got room to grow her estate.
Wow, so she could pass
Another
$6.8 million?
Without paying tax on it.
Wow.
Provided she comes to either an attorney or a tax preparer and files that 706 and makes a portability election.
So that's a very must to do.
Yes.
Is there a time limit on that past date of death, Carla, that needs to happen?
Well, usually we did have an exclusion where we could say, oh, dear IRS, we didn't make this. But now it's basically we can put the return on extension at 9 months, and that gives us another 6 months. We have about 15 months before we file the final tax return.
That's not a lot of time to think about grieving and filing tax returns.
No, it isn't. And a lot of people seem to think that they can settle an estate within a matter of months, and that's not true in most cases, because there are a lot of things to think about. And you need to go through that grieving process before you really start looking at things, I think.
Better to make decisions when you're not
It makes more
emotional.
reasonable decisions than emotional decisions, exactly.
So continuing our example, I think we talked about one avenue, and Carla, we just mentioned this, is allocating more growth-oriented investments to the Survivors Trust so we can grow from that $4 million on up to the 6.8, get the second step up in basis, and be estate tax-free and capital gains-free after the second death. Did I hear that correctly?
You did.
And the bypass trust, to the extent that grows, then there would be realized capital gains along the way.
That's
and then
correct.
those securities would be distributed out to the final beneficiaries, but not with a stepped-up basis.
That's correct.
Wow. So it almost sounds like for estates under 10.8 million, you really want to have that second step in basis to try and preserve wealth across multiple generations.
We do. And the other thing you need to remember right now is this is the rules for 2015. Obama in his State of the Union address earlier this week was advocating some changes. So, we're not real sure where we're going to stand with this at the moment.
So we have some ongoing uncertainty in this area.
We certainly do. But once a bypass is funded, it's funded.
Tell me a little bit about, you mentioned something intriguing. So you mentioned if all the assets are in retirement plan and house, and it's not desirable to have either in the bypass trust, I think you mentioned that you could take a note.
So let's say that we have, and this is very common in people nowadays, especially in California. So let's say we have a $6 million estate, and we have a $2 million house, and a $3 million IRA, and $1 million worth of investments.
Sounds like a lot tied up in not so liquid assets.
Exactly, and that's what happens a lot of times. So we need to fund the bypass trust, and we need to fund it with $3 million.
Which is half of the estate.
Which is half the estate. And all we really have, we don't have that much to fund it with, let's be honest.
House, IRA, or cash, and
yeah, so we're going to have to fund it with probably half of or part of the house. And to do that, we may take, rather than put the house in there, we may take a note against the house and fund the bypass trust with the note.
Okay. So the survivor would take the house and have an obligation to the bypass trust.
That's correct.
To pay for that portion of it. Do they pay interest on it?
Yes.
Okay. And what happens to that? Does that get taxed at that 39.6% rate? Or can it flow through?
What happens with it is sometimes when the interest is paid, it is taxable. If it is structured correctly, then you may be able to structure the interest that's paid as an investment. And then so you have interest coming through in an investment. But you have to be very careful how you structure these. You will really need an attorney in here to make sure that it's structured
Sounds
correctly.
like a don't try this at home sort of thing.
Exactly. Or if it's the main house, you may want to take it through as mortgage. it's really hard. Or investment interest, or rental. Let's say you have a rental property. You want to make sure that the note is secured by the house. I had this happen earlier, where they never secured the house with the note, and it was really an ugly situation.
Sounds like not a good situation.
So you need to structure it carefully. We have a question that came in, and it's a very good question. It said, how often should someone revisit their estate plan? And it used to be that we used to say once every 5 years. And with all the changes that are going on, I would say probably every 2 to 3 years at this stage, if there's significant changes. In either the tax laws, the asset structure, maybe we need to look at it because the surviving spouse now is in assisted living and needs a lot more income. Those are all reasons to look at it. Or, maybe one of the children got married and we don't like their new spouse. There's all kinds of reasons to go in there and take a look at it.
I would imagine also that if some of the key players, is we often pick our peers to be our key people, our executor,
Exactly.
our successor trustees, and as we age, oftentimes they're aging too, they might not want to take on this burden.
That's correct. And so you may just need to look at it. You may not need to change anything, but you need to revisit it. Okay.
How important is it to read the estate planning documents?
I think you should understand your estate tax planning document, and I think you should go through it with the attorney, and if you don't understand what's in there, you need to talk to them about it. I had a situation the other day where someone came in and said, my father's 94 years old. I know I'm going to inherit a great deal. I have no idea what his estate plan said. Nor do I understand what it says. And it was obvious from their questions that they did not understand what was going on. So I think it's really good that you, those people who are drawing it up, the trustees, the original trustees, the surviving trustee, and understand what's going on. Especially with some of my older clients where the woman might not have been involved with estate planning or with the finances, it's really important that she gain that knowledge.
Yeah, absolutely. How many times have we seen a spouse who has been supposedly in the loop or aware of decisions being made but haven't been an active party, and all of a sudden they're in the position of having to make financial decisions and implement terms in the trust?
Yeah.
It happens more often than...
It certainly
Hopefully, as a result of our conversation today, we have people heading down to their safe deposit boxes to dust off their estate plans and do some review. Carla, what are some of the areas of concern for clients that you're seeing?
I think one of the alternative minimum tax, quite frankly, for my clients is always a huge issue. And we're looking at seeing that again. I think the other thing we're seeing at this stage is actually doing the estate plans, how they're structured with the new tax rate that's in. I think that we need the portability issue is a huge issue for a lot of my people because they don't realize that it's what that entails.
Let's talk a little bit about portability because you've mentioned it a couple of times and we've been talking about this example where there was mandatory funding of bypass trusts. But talk a little bit about portability and how that might help alleviate some of these irrevocable trusts and compressed tax rates.
What it used to be was, if let's say you had the 8 million, our prompter here is telling me we only have 2 minutes.
I thought that was 2 questions left.
2 questions? Okay.
No.
Whatever. Anyway, portability allows us to take the exclusion that one spouse doesn't use and give it to the surviving spouse, which is a tremendous advantage for the additional spouse. As we saw in the one example that we talked about earlier, if the exemption is, and I'm just going to round it to 10.8.
Sure.
And we only had an $8 million estate, we had the extra $1.4 million that we could give to the surviving spouse. That's portability. So now she has another $1.4 million on top of her exclusion. When she dies, it's not going to be taxable. And especially for smaller estates, that's a huge issue.
I can see that. So in terms of the question that came up, what have you seen recently? We saw a situation recently where we had a client with a trust that had a survivor and a bypass component. The bypass was mandatory funding, and this particular client, they didn't have any kids, they had charitable wishes, and they each agreed that if one were to die, the remaining assets should go to the surviving spouse, free and clear, no strings attached. I mean, is that a situation where we could eliminate the bypass trust altogether and just have everything go to the survivor? And
that that's really a legal question, which is one of my favorite things I like to say. Is I'm a CPA, not an attorney, but in answer to your question, probably. But again, that's legal advice, and I can't give that.
So we need to bring in our attorneys on that conversation then.
Absolutely. Which kind of relates to our next question, what are the components of a good estate plan? And a good estate plan I think there's two major components. We do a lot of estate planning to avoid taxes, but really an estate plan should carry out your wishes for your estate after your death. Where do you want that money to go? Do you want it to go to charity? Do you want it to go to the children? How do you want it to go? Do you want it to support your spouse? All of those things are really issues in that estate plan.
What about during life? Handling incapacity and healthcare decisions
Absolutely.
And agents for making medical decisions?
And those are part of a good estate plan too. And I think the other thing, there are two parts to estate plans that we haven't really dealt with in the past that we're looking at more and more. One of them is the incapacity issue, because we're living longer, we have more Alzheimer's, more dementia, is allowing for who assumes responsibility at that stage. Do we have a family member? Do we have a friend who may have dementia too at that stage? Do we put in a corporate trustee? Do we hire a private fiduciary, which is a new term that we haven't had before, to come in and help us manage that estate? Those are all really good questions.
All good questions, and probably better to have answers beforehand rather than after.
Absolutely, and the healthcare directives that's another issue that comes in. The one thing that I see frequently with healthcare directives is it's going to be my children. Well, if your children are in New York and you're in California, that's probably not a good idea.
Probably not.
You probably need to find someone that's closer, so that if you have to go to the hospital in an emergency, there's someone that can help you out.
Last but not least, and we were talking about this before the presentation today, there's three places that money can go when we pass, and that's to our heirs, to the government, and to charities. And I think it's important to decide which one of those institutions or people we want to fund beforehand rather than after.
That's right.
As we also tell people, if you don't have an estate plan, the state of California has one for you. And
that's right, and you won't like it.
You won't like it.
That's correct.
So, with that, Mary, do we have more time, or are we just about out of time here?
We're at +3 right now.
Okay, then thank you for joining us. We had a great time, Carla. Thank you for being here. And if you have questions, feel free to email, and we'll be glad to help out. Our bios are in the back of the handout.
Sounds good.
Thanks for joining us today.